All right, so today I'll be covering a topic that's, I think, one of the key reasons why trading, folks fail at trading, right? You probably heard of this, that when folks sell their signals and all that, that it works in all markets, all time frames, etc., etc. And also with the Wyckoff traders, typically the day traders, they will use a wave chart intraday, and um, this is all not true, because time frames are split up in two categories. There's the structural and there's the entry. The mistake folks make is saying, oh no, it works on this time frame, that time frame, and not distinguishing one time frame from the other. There's a major difference between time frames, and I'm going to explain what they are and why, if that's not used, there's no edge. So structural time frames have other time frames beneath them, and therefore they are used, their levels are used. Their levels are used by many traders. All right. Entry time frames are time frames do not have levels that are used by traders. So the example would be 5 minute, 15 minute, and below. Even the hourly, more or less. I mean, yeah, it's used, but definitely the 5 minute, 1 minute, 1 to 5 minute, right, and the 15 minute, etc. These are entry time frames. Where here you have definitely the daily and above, and you could also say the 4 hour. Certain 4 hour used as well. So this is the key difference between a structural time frame and an entry time frame. Now, why is this important? When you have traders that are referencing the same time frame, it increases the probability of success. So if traders that are using the daily, you have the 4 hour. Okay, so let's just take an example. The daily, right? Those levels are being used by 1 hour, basically all intraday day traders are using this. Our major traders, right? All intraday day traders reference the daily levels, and the key here, that's the key. All right, so this means more supply and demand are at these levels. More supply and demand orders are at these levels because more traders use them. That really is important, because you cannot say a daily level, or all time frames are the same, or this signal works on all time frames. It's not rational, because certain time frames have so many other time frames underneath them that their levels are much more important and have a higher probability of working, because more traders are using them. In fact, even your platform will have, daily high, daily low, daily high 2 days ago, daily low 2 days ago, 3 days ago, etc. High of day, low of day, high of yesterday, low of yesterday. So this, and even the stops are above these, the low of yesterday, the high of yesterday, etc. So that's not the same as a 5-minute chart. So this is the key problem with any technical methodology that signal or whatever that's being used on time frames does not take this into account. And anyone who says that it works on all market, all time frames, they're full of shit, and they're just trying to sell you a product. So the structural time frames versus entry time frames. Now I'm going to focus on entry time frames. The key thing here is that their levels are not referenced, or they're referenced by very few traders. Very few. These time frames do not have levels that are used by traders or are used by few traders, or are used by few traders. All right, so who the hell uses a 5-minute level or even a 15-minute? Nobody uses it. But 15 minutes, the entry time frame for 4-hour levels and the daily. So that's why, because it's not important, because it's not being used. All right, so you have time frames that are broken down by structural time frames and entry time frames. So structural time frame is what you must be looking at for trades. Structural time frame identifies what? It identifies where to find trades. Okay, structural time frames tell you where to find potential trades or trade opportunities, where to find trades. Entry time frame are telling you look for signals and triggers. That's their purpose. All right. At the structural, when price is at the structural level of a daily or a 4-hour or weekly or monthly, then you use the entry time frame to look for signals and triggers. Entry time frame, signals and triggers, not levels, and structural are where to find trades. Okay. Now, why is this important? Why? Because it's a number one. I don't know. Maybe one of the top issues with most traders and white cup traders is they will look at the 5-minute chart all day. This is an error, is to look at the 5-minute chart all day or 3-minute or whatever, thinking they're learning how to trade or getting screen time. This is all bullshit, right? In my opinion. Why? Because entry time frames are unstructured. They are unstructured. They have no structure. Meaning their structure, because their levels are not being used by other traders as reference points, they are unstructured. They are unstructured orders and unstructured data used for placing orders, not for finding trades. Okay, they are unstructured data, they're unstructured levels, they mean nothing because they're not being referenced by a lot of traders underneath that particular time frame. So it is an error to look at the 5-minute chart all day because it's unstructured. Because it's unstructured data and orders, that means will have a lot of. I mean, it's just, it doesn't even make any sense to look at it. But what you'll see is many traders, especially Wyckoff traders, they'll put a wave chart, 5 minutes, just watch it all day. They're taught to trade one market. And so by a lot of these funding companies, so they'll just look at that same market all day. Oh, look at oil going up. Today the market is down, or today the market is up, or today it's a trend day, or today it's a range day, or this or that. So it's unstructured. So it is meaningless. So this is why even looking for change of behavior intraday is very misleading. It is totally, because it has no context. It's not within the context of a structure. It is unstructured data, selling and buying for no purpose other than for any purpose. It's not no purpose, but for any purpose, and does not create trend equally as much as it does. So it's just total crap. So this is what I wanted to identify, because it is an error to look at the smaller time frames all day looking for trades, because you should be looking at the higher time frames that have structure, that are being referenced by a lot of traders. Those are the levels and that create the structure required for for more buying and selling to come at those particular levels, offering opportunities. All right, so this is a very important point, and that this is important because remember this: most methodologies, technical methodologies, do not have a reference or anything to say about time frames. Most technical methodologies, whether it's momentum or whether it's Wyckoff or Gann or Elliott, they don't have anything to say about their approach on specific time frames. Their approach is independent of time frame, or at least that's how people perceive it, and they do not mention that it works on this and doesn't work on that, or it's more likely to work on this, or anything like that. Technical methodologies do not consider time frames. At the most, they may consider, okay, they just don't. Most of the time, they don't. People who use them, who know what they're doing, will, but the methodology itself, typically, it may mention, but most folks will not use it, it's just not used practically. So, for example, in Wyckoff, I'll give it a real concrete example. In Wyckoff, the idea to use the intraday wave chart, right? Most folks that are trading will use the intraday wave chart in isolation. It's a big mistake, because even the guidance that Wyckoff had given was specifically, when he talked about trades, he said, if a market is swinging back between 30 and 35, you should look for longs near 30 and sells at 35. Meaning, if the market is range bound, you look at support and resistance, or demand and supply zones, and those are the areas you want to start looking at the wave chart to see if there are changes of behavior, or whether there's buying and selling at those particular levels, at those edges, right? That's the example that he had given verbatim. Literally said 30 to 35. Now, what is the time frame he was referring to? Well, 30 to 35 was referring to the daily chart. And the idea was to use the daily chart in conjunction with a lower time frame wave chart for entries. Now, he said that, and the second approach was to use just the wave chart by itself on stocks that had big range, lots of activity. In those particular situations, because they have a big ATR, you can look for turning points, because they're swinging back and forth, and they have large activity and points and all of that. But even then, he had referenced that the ideal way to make big R, to get 8, 9, 10 R plus, is to combine the wave chart with the higher time frame daily chart. So that was the guidance that's given. But if you see the way it's being used, most traders, especially trading one time frame, are just looking at intraday, and it's unstructured data with too much degree of randomness, and I don't think it works. So, all right, so that's what I wanted to mention. All right, so I'm done with this. So I've broken it down into structural and entry. Structural is used by a lot of traders, so those levels hold weight because they're used by a lot of traders, because the daily is used by the hourly, the 15-minute, the 5-minute, all of those traders underneath it, the intraday traders, will be referencing the daily. All right, whereas the entry time frames do not have a lot of time frames underneath them, and because they're not used by a lot of traders, their levels, it is pointless to use them. It's pointless. And that's why structural time frames tell you where to find trades, and entry time frames identify signals and triggers. All right, so that's the idea. Other point was it's error to look at the 5-minute chart all day because it's unstructured data. It has too much degree of randomness. So that it may create a higher high, higher low. Then it's trying to create a higher high, but it'll make a lower low, and then another lower low, and then all of a sudden higher high. It'll do this in a way that's very chaotic. All right, because its levels are not being used. They are meaningless. It's just orders being filled. All right, so that's the first part. Now, let's just take a look at the market and see what's going on. All right, so on gold, okay, at the top, I have the daily, and the bottom, I have the Renko levels. All right, so the idea is that the top is the daily, is the higher time frame, and that gives you the overall direction, and the middle time frame is in the Renko chart, which gives you levels. And once the market's at those levels, you look for traders. That's all. All right. So what we see here is gold. You have a lot of selling at 2058 and a lot of buying at 1990. So what's the market doing right now? It's right in the middle. If it goes down, it's going to that 1990 area, which is not too far away. And over here, you have a high volume area. So it's very likely gonna go and test this brick near the 1990. So it might go to 2000. Very nice level to go to, and you should definitely look for selling. Actually, it's selling now. So I'll take a look at this later, but that 2058 level, if it goes there and then sells off all the way down to 1990 or 2000, that would make a lot of sense. Why? There's selling pressure up here. Why? Because the biggest brick in last 40 bricks of selling pressure here should be meaning it's redistribution there that created this wave low. So our price goes there, you have a clear edge. Why? A lot of selling there. So what do you do? Is the selling still there? If it is, get in. Where will it go? Daily demand 1990. All right, next is the crude. Crude is 75.42 and 68.53 with a rotation up. It looked like it was turning. First of all, it totally fucked up right over here because right here you had an opportunity for this to sell off. But the buyers, this was the biggest volume in 58 bricks. They did not want to break there. They bought up all the selling and continued higher. So I think it's targeting the 75.42 area. Why? Because it didn't break here. And that area had a lot of pressure. So you had the biggest volume in last 11 bricks. And what happened? It got reabsorbed. The selling got absorbed, and it went higher. So that makes me think that the level to look at is a little bit higher, which is 75.42. And there you have all this shit right here, the supply zone or level or distribution that initiated a big down move. So if it goes there, it should have selling. This this was a real pain in the ass too. On the ES, playing a lot of games, so 40.75 and 41.88. It went to this selling area and finally reversed down on the biggest selling of 53. I have to see how this thing is playing out because you have a very strong demand at the 4,000 that's untested. So if this breaks, it can go down. However, the daily, there was a lot of buying pressure. The biggest range in 30 bars. So that makes me think it wants to go to 41.88. However, if it doesn't go there and it sells off at this selling zone at wherever it is, the 41.50s, then, and if it sells off, it can easily go down to that 4,000 level. So, that's what I'm looking for. So between 4,000 and that 41.88. But I will take a look at this because there's selling pressure, significant selling pressure, biggest selling in 53 bricks. And if it doesn't get absorbed, it can easily go down. So is it going to go to 4,000 or is it going to tag 4,100 and then reevaluate to see if it's going higher or lower? And that's it. All right, thanks. Bye.